Right, let's continue on that theme. We're joined now by Herschel Jawitz. He's Jawitz Property CEO. Thank you very much, sir, for availing yourself this afternoon. So as we anticipate that announcement by the Reserve Bank, let's take a look firstly maybe at your outlook for the property market for 2022. 2020 was characterized by first-time purchases. 2021 characterized by a return to market from existing property owners. Your outlook for the year ahead?
Thanks, Judy. Thanks for having me. So I think the outlook ahead, I think, is going to be stable. Obviously, a lot of it is going to depend, as your previous guest spoke about, the interest rate cycle. And I think to some degree consumer confidence as well. So, home buying, whether it be for investing or to live in, is very much a long-term buying investment decision. So it is interest rate dependent, but I think it's also based on consumer confidence, how people are thinking about the country. We're going into an ANC elective year. There's going to be a lot of noise around that. But I think just to put it in perspective, there's a lot of concern about we are in a rising interest rate cycle. There is talk of 3 to 4 interest rate increases over the year. Even if interest rates go up by 1%, and that's very possible, and interest rates end up by the end of this year at 8.25%. They're still 1.75% off where they were at the beginning of the COVID pandemic. And by South African standards, interest rates at 8.25%, where many people are borrowing at fractionally below prime, is still very, very, very competitive. So my prediction for the year, I think we've seen a lot of that fizz that you spoke about, the first-time buyers. A lot of that fizz has come out of the market. It still is active. But I think that interest rates are going to potentially take out a layer of affordability and push those people back into the rental market for the time being, number one. But we're also starting to see a shift and an improvement in the mid, upper, and top end of the market. And that market is less interest rate sensitive and perhaps benefits more, for example, from what we've seen in the stock market. So there's a wealth effect. Dividends are starting to flow back into the market, whereas they were on hold during the COVID pandemic. So I think we're potentially going to see a rebalancing of the market, maybe away from first-time buyers, but I think it's still going to be sustainable. I think the bank lending environment is going to remain positive as it has over the last couple of years. And I think also property price growth remains relatively flat. And so even with interest rates at 8.25%, with bank lending remaining positive and property price growth relatively flat, it still remains a very attractive buying opportunity for those buyers who want to get into the market and for those who can afford to get into the market.
We've enjoyed some reprieve for the past 2 years at least. So you rightfully mentioned, as spectator after spectator has pointed out throughout the channel, that an increase is inevitable. So what does this mean essentially for a first-time buyer should the Reserve Bank announce that 25 basis point increase in the repo rate?
So I think for a first-time buyer, if rates go up today by 0.25%, which they're expected to do, it's a very simple calculation as to when rates were at 8%, they were at 7.25%, now they're going to go up to 7.5%. What does that do to my repayments on what I could afford at the end of last year? And let's assume on a R1 million bond, the repayments would probably be round about the 8 or 7.5 to 8,000 rand mark. They've gone up fractionally if rates go up today, as we expect them to do. But I think most importantly for first-time buyers, it's not about what happens to rates today. You've got to leave some room for if rates go up by another 0.5%, or 0.25%. If rates get up to 8.25% and maybe even 8.5% by the end of the year, that's the real calculation that you've got to start doing to yourself. And then out of that calculation comes a decision around, do I spend less on a property to make sure I've left some wiggle room for rates going up, or do I look in areas that are more affordable, where I'm going to get the same or better bang for my buck, but at a lower price? So it's either going to mean looking for areas that offer better value, or if you're insistent on the same areas or the same type of house or the same size of house, potentially buying down. But I think the decision is you've got to take a decision that allows enough maneuver room for at least a 1 to 1.25% rate increase over the next year.
If I do not have the appetite for whatever reason to buy property and I am renting, what consequences then follow this increase in the repo rate?
I don't think at the moment in the short term there's going to be a specific consequence. As your earlier guest spoke about, I think it could have been John, but I'm not sure, I couldn't see. When rates were low, we saw a lot of renters turning into the buying market. It made sense from buying a property and putting your own repayments in your own asset. It even made sense from a cash flow point of view. Repayments in some circumstances were less than what you were renting the property for. I think if you're choosing to stay into the rental market because you're concerned about interest rates, the rental market is very subdued at the moment. It certainly is a renter's market, and I think that you've got to use the opportunity to rent wisely, rent cost effectively, and try if you can to rent where it gives you an opportunity to put away some money, accumulate some money for a deposit if you can, even if it's a small deposit, and wait for the interest rate cycle to shift again or to level out, or wait until you have a deposit that affords you the opportunity to buy, where you have to take on a smaller bond, less debt, and that fits in with your affordability and what you can afford to repay.
You almost are reminding us of the age-old argument, right? To rent or to buy, which one is better? But from what you just said, it's imperative to assess your own financial situation and not put yourself under pressure until such a time where you can afford to own a property.
Yeah, absolutely, Jude. I think that I can't emphasize it enough. Buying a property, it's not a liquid investment. It's not an investment that you can, like shares that you can, or unit trust that you can invest in today and you can sell tomorrow. And there's a small transaction fee. It's time, it's money. The transaction fees, it's transfer duty and commissions on the way in and the way out are high. So you really have to take a long-term view if you're buying a minimum of 5 years. In order to almost think of getting your money back, and I include, for example, your transaction costs, your transfer fees, the cost of moving, if you've got bond registration costs. What you don't want to do is get into a situation where you buy today because you can afford, and you're forced to put the property on the market in a year or two or even 3 years. As to whether it's going to turn out to be a good investment, I think residential property, has it been the best financial investment over the last 5 years or last 10 years? I'm not 100% sure. You probably could have got a better return with a bit more risk in, for example, other markets. But I think that, you've got to look at it beyond just investing, a financial investment. I think it's an investment about security. I think it's an investment about your family. And when you look at South Africa, one of the keys to a stable and a growing societies is the issue of home ownership and land ownership. And so I think it extends beyond just crunching the numbers.
Indeed. You speak of investments. A number of people are purely in the game to get fixer-uppers and they then resell them to make an extra buck. What are the trends showing us when it comes to properties that need renovations and people just moving in and out purely for that?
I think there was maybe it's a while ago in the booming markets in the sort of 2006, 7, 8. I think there was a very strong speculative market. You could get in, you could do some renovations, and you could get out. I mean, we've seen over the last number of years that speculative market has almost disappeared. You've got to buy exceptionally well. You want to know what you're doing in terms of renovating the property, what's going to sell, what the market is looking for. And once again, there are people that are doing it. There are people that are making money. But looking at your viewers in the eye, I think you've got to be very careful in this market. It is a buyer's market. People aren't paying premium prices across most parts of the market. So I think you've got to be very, very careful about speculating in this market and making a quick turn unless you can get properties at rock bottom prices.
Herschel Jawitz of Jawitz Property. He's the CEO there. Thank you very much for talking us through that and what to expect for the property market in anticipation of that MPC announcement.